thanks again to the panelists, and I would request them to, if they could turn their video on now, if that's convenient, and I would just like a 2-minute introduction on each panelist and your person as well. We can start with Neil Dutta.
Thanks, Neil. I appreciate the opportunity to be part of this panel. So the quick overview, I work for the Forbes Family Trust, which is a large multifamily office based in Palm Beach, Florida. We were institutional investors for the last 30 years. We invest across the capital structure, but primarily in equity strategies, both directional, non-directional, and as well as systematic and trend following strategies.
Very helpful. I would like to actually give a little background on you. You have a very impressive background. You were responsible for an $8 billion portfolio in your previous position at Arden Asset Management, a fund of hedge funds group. And you spent 5 years with the New York State Tax Department as a forensic investigator for uncovering tax evasion. And you're a national founding father of Sigma Beta Rho multicultural fraternity at SUNY. So thanks for your introduction.
Thank you.
And next we'll go with Ahmed at Koch Disruptive Industries.
Hi, thanks so much for the opportunity today. So I'm a director at KDT, which is the growth equity and venture capital arm of Koch Industries. So the group was founded by Chase Koch about 2.5 years ago. Vision that we would bring the capabilities of Koch Industries to startup and principal entrepreneurs. So we're stage agnostic, size agnostic, sector agnostic. We've done everything from $10 million Series A's to multi-$100 million later stage deals, everything in between, across semiconductors, software, networking, industrial tech, healthcare. We're about a dozen portfolio companies today, about $1 billion capital deployed.
Thank you. And Ahmed, I know you have prior technology experience at Evercore on the investment banking side, and also you're on the pre-IPO team at Pandora Media and the audit practice at KPMG, so pretty well-rounded. Plus you have an MBA from Columbia University, my alma mater, which is always good to see.
Thank you.
Steve, we could go next with you.
Yeah, so hello everyone. Steve Kim. I'm the partner responsible for investment strategy for a single family office outside of Philadelphia. It's a branch of the DuPont family. My background is in technology and operations. After graduating from Florida, I started my career at the Walt Disney Company. Was a systems architect and project lead. My last assignment was helping open Euro Disney in Paris. Then went on and spent some time in telecom, in optical networking and network management, and then was CTO, Chief Technology Officer of several public and private companies. The last company I was with was Orcom, which was sold to Alliance Data Systems, a large public company in Dallas that I spent some time as CTO, and then got together with my partners in 2004 to start the family office. We're very prolific investors in early stage venture. We've started an early stage venture program in 2006, and we've already invested in 18 early stage funds with about underlying exposure of about 800 startups. So we're continuing to do that. Our next program will actually invest in 20 to 25 early stage funds, hoping to get exposure to roughly 1,200 startups.
Appreciate that. And I know, Steve, you invested, like you said, over 60 managers globally. And thanks for opening Euro Disney. I'm going to visit that someday. And you're on the board of governors for the International Baccalaureate. So anyone going for a bachelor's is probably friendly with you. Bill Todd, we'll go with you next.
Yeah, we are Landmark. It's a 300 member investor group, which includes 140 family offices, prominent names. And we've basically put that all together since the 2009 era. We did that primarily because we weren't sure where the VCs are going to be on our takeout side, when our B rounds and later rounds. And so we went directly to the family offices. So we have some prominent names in that mix. and they're investing quite a bit of money per deal, early stage, later stage. And we also do social impact investing. And the impact side of what we do is in the ESG side, primarily healthcare, energy, and a little bit in the education side. And that's important because that's a separate investment source from our normal investment dollars from the family office side. Our high net worth guys come from the financial industry. They come high-level corporate executives, individuals who have owned or currently own substantial businesses. They invest on average 250 to 350. That's for each individual. So we form syndicates, and that's how we get to do our larger deals. So we position ourselves in between where the VCs used to be in the early to growth stage, where they are today, as you know, is the later stage investments. And of course, most of the angel groups are the average angel investment is only $250,000 per investment. And it usually takes 10 investors to get to that 250 level. So by getting deals done in the 3 to 5 million range, we've got plenty of opportunities on the venture side. We also do impact investing, as I mentioned, and then alternatives. So for the family office, it's just not venture. We look at the IRRs in the 14, 15 IRR categories over a 4 to 5 year period in real estate, private equity / M&A, real assets, could be oil and gas, commodities, et cetera, plus venture. So that combination is a very good combination. Other information is on our website, landmarkangels.com.
Thanks, Bill. And I know that you're not only head of Landmark Angels, but also CEO of Landmark Capital and president of Landmark Family Office. And interesting background, you completed over $3 billion in financings, major law firms at Lehman Brothers, and you were president of an enterprise software company out of MIT, and you were a Phi Beta Kappa Summa Cum Laude graduate of Notre Dame, and a JD from University of Virginia Law School. So thanks to all the panelists for joining us today, and we will get kicked off with the meat of this meeting, really. I want to ask one general question, and we could just go in the same order, starting with Neil. So are you focused, Neil, on new opportunities or niches due to COVID, such as health tech, fintech, or virtual solutions? I mean, basically, has COVID focused you on new opportunities?
Yeah, one thing I think is consistent that we're hearing from our managers as well as in our own investment committee is that COVID, more so than starting new trends, has accelerated existing trends. And for us specifically as investors, we are looking for more opportunities in the healthcare space, healthcare, biotech, pharmaceuticals, therapeutics, anything that's very scientific, sensitive. I think from our perspective, that's where the edge is a lot of times when folks understand the science as well as the economics behind the industry. The other thing that I think outside of healthcare and biotech is, generally speaking, a lot of our portfolios, the concern is, even before COVID, 10-year bull market. So a lot of, not just the families, but our portfolios are looking to get more defensive, less correlated S&P strategies, things that are more market neutral and potentially less correlated to traditional, directional strategies.
Gotcha, thank you. Ahmed, would you like to go next?
So we've actually been, we like to say core to our thesis of we're not focused on any specific sector. For us, it's all about, what creates what we call virtuous cycles of mutual benefit. So, how can we create value for companies and then value to Koch Industries and also create value for society? So we actually we announced this last week. We led a $71 million round in a company called Side Diagnostics. So what they are is a CBC tool for fingerprint blood analysis. And the approved device, it's now commercially available. So, and we've actually made several other investments as well during COVID that we just haven't announced yet. So for us, this has been a very, fortunate and busy time to find companies that are, truly disrupting the markets that we're investing in.
Thank you. Steve.
Yeah, so that's a great question. We've always been very sector agnostic as well. And very diversified. And I think that's really, really important in, you know, times like this where you have tail events or recessionary periods. You can't forecast what sectors are going to do well and what sectors are going to do poorly, and what companies are going to do well and companies are going to do poorly. So if you look across our portfolio, what's really, really interesting is we could have never forecasted the winners, but there's been some strong winners in the portfolio, and there's been some losers as well, but the winners have more than made up for those losers. And I think, you know, that's one of the advantages of being diversified and being sector agnostic. Now, in spite of that, we have had an investment thesis around life sciences, especially as it relates to therapeutics and biologics. And that's certainly been a tailwind at this period. But, you know, that sector, it's not because we were trying to be picking sectors, but we just like the return profile in that therapy space. So we've consistently invested there, and that's been a really strong tailwind. I think what's important to remember is that, you know, is staying invested in recessionary periods. I think that's really the meat of it. If you look historically, you know, recessionary periods have outperformed by 200 to 300 basis points over non-recessionary periods. And I think it's really the discipline of staying invested in those periods and taking advantage of those periods that's really, really important versus, you know, tilting towards sectors or making bets on particular companies. It's that discipline of staying invested, because as a long-term investor, you're going to lose a lot of compounding if you pull back during recessionary periods.
Exactly right. Bill, please.
Yeah, well, we have a philosophy. We go have a 3-person review committee that reviews all our deals, and our philosophy is we look 3 years ahead. So we want to make sure there's a defined exit likely to come within you know, some relative period of time, at least 5+ years. And we want to make sure, based on all the due diligence factors, strong teams, strong boards, serial entrepreneurs, that the company is likely to be there 3 years from now. Back to Steve's point is, if we can avoid the 80% write-offs that the VCs have in general, but we're going to do much better. Meaning, if they're still in play, and what does that mean? That means we can basically look to have them in some exit strategy via sale of the underlying IP. It could be a repositioning of the company, or it could be even a sale of a corporate side that we know of that we can get most of our money back. And that basically cuts down the losses and increases the returns. What we invest in, like the others have said, is across the board pretty much in the industries, but ones we focus on are healthcare, energy, AI, robotics, emerging tech. Those are the primary areas that we invest in, and we've done pretty well. Areas to avoid in this COVID area are probably going to be, which everyone knows, hospitality, transportation, but there are opportunities there too. So it's not that you avoid them, that you have to find the cream of the crop in those industries there, because they're transforming too. There are different ways. Retail is a different strategy online than it was. The same thing on transportation. It's going to be all redefined. In terms of the healthcare side, yes, we do a lot COVID related. We weren't sure where our investors are going to be when this basically we were all self-quarantined starting in the early part of March. But we've done very well on the virtual basis, and we've done and what we look for there on the healthcare side: life science, device, diagnostic, digital health, all the above. We do 2 major forums a year in that space: health innovation, mostly focused on the device diagnostic side, and investing for cures, which I founded 10 years ago. The premise there is best investors with the best science, and perhaps we can make a difference toward the cures. We've had very good results. NIH is a major sponsor of our forums. It's a very good group. It's Jody Black's group at NIH, Extramural, and they have over a $5 billion annual budget. And so we look for opportunities there, best companies, so we can make a difference in that space as well. Gotcha.
Thank you. For the next question, we'll start with Ahmed, because I know that Coke's a pretty global corporation. Ahmed, do you focus on any regions within the US or abroad? Which verticals are you generally investing in, and what stages do you participate in? And how do you partner with other investors? So you can just pick anything of those multi-part questions that you like.
Great questions. I'll give a broad brush answer. So we're not region focused. So we've invested in companies in the US and also in Israel. So actually we've invested in think 3 or 4 Israeli companies, actually 4 Israeli companies today. So we actually also have an office in Israel. Very broad. We've invested across semiconductors, infrastructure software, medical devices, surgical instruments, and networking, and all across the board. In terms of, again, stages of companies, we're looking for what we call like highly disruptive businesses with massive potential. So our flexibility, our real differentiator, we call it twofold. So first, we want to be the unique capital provider. So we don't have minimum check sizes, maximum check sizes, ownerships, concentration limits, and none of those. And then for us is the second thing is what we call Coke Labs. So how can we bring different capabilities within Coke to basically help the company grow to reach, its potential? Again, we don't have exit horizons. We don't have hold time periods or IRR requirements, any of those. We really think about everything on a very individual basis. And for example, Outrider was an investment we made, Stealth Mode company investment we made last year. They were developing an autonomous trucking platform. So Coke has a lot of yards, and we're able to help them rapidly innovate their product within, our yards.
Gotcha. So Steve, I know you answered part of this question. So maybe you could tell us about any regions or global strategy that you have and what stages, and if you partner with other investors.
So yes, so what's interesting is we're sector agnostic, but we're very, very stage focused. So we only invest in pre-seed, seed, and early A, basically first institutional check. We think that, historically has generated the best returns, and it's also an opportunity to get into startups at the cheapest valuation with higher ownership. So we take advantage of that. We're also very geography focused. So when you look at our strategy, we're very outlier driven. We think that, outperformance in venture capital is because you're in outliers and you're capturing outliers. And if you look at outlier production across the world, it's very, very geography focused. And it's almost down to the cities. So there are certain cities and regions next to cities that produce the lion's share of outliers. And if you look at the US, it's 65% in California, 12% in New York, and then the balance across the rest of the country. So if you're really looking for venture-like returns and outperformance, you really need to look at the geographies and where those outliers are being produced. So our strategy is very, very focused on those regions. Worldwide, we keep our eye on what's happening. And China, especially Beijing and Shanghai, have been very strong cities as well. So we spent quite a bit of time there. We haven't made an investment, but that's certainly a region and cities that are really, really starting to produce some outliers, some great companies over the last, kind of 5 years or so. So it's definitely a region to keep an eye on.
Absolutely. Bill, please, you can answer any part of that question you like. Bill.
Yeah. International side, we do co-invest as well in some Israeli companies, the UK and the EU. And in fact, as far as we had one in Australia. It was a COIR, C-O-I-R product, which is made from coconut derivative. One of our family offices invested in that because I knew a little bit about the space. It's a good investment, 5 million plus in that space. It's geographically the farthest. In terms of co-investment with other VCs, yes. And they look upon us as 2 ways. One, we can participate because of the amount of monies we can put in into a particular deal as a co-investor. And secondly, in terms of the flip side of that is the investment with basically into public companies as well. And there our goal is to invest in smartly in ones that have significant market caps, but where we can add a value. So we've done that type of investment as well. So the parameters with other angel groups, we've invested with some of the major ones, Tech Coast Angels. We do forums with them twice a year for the last 10 years. Harvard Business School Angels, New York Angels, Keiretsu Group. So we invested with pretty much all of them because it aggregates the capital side.
Gotcha. Neil.
Sure. So in terms of geo, we're quite diverse. You know, where we have large relationships in Australia and Asia and Europe. Not so much in Africa, in South America. So probably areas of growth for us. In terms of stages, where you know, just by nature of our ticket sizes, we're typically later stage investors. You know, the earlier things we do are probably through the early stage VC funds, just by nature of how we invest. And you know, in terms of the sectors, we're definitely all over the place, but you know, definitely a focus on tech and healthcare these days.
Great. My next question is pretty quick, I think. Steve, can you discuss any recent investments you've made during the pandemic or plan to make after the pandemic? I suppose you can't say their names after the pandemic, but
Yeah, I can talk about that kind of broadly. We think a really interesting area and one that we've been paying attention to quite a bit is emerging managers. We traditionally invest through funds, and that's because we like the diversification, and it's really difficult to get diversification via direct investing. But so we've focused our investing through funds, and we just see a lot of things happening as far as emerging managers that are developing. You know, they've got great networks. They're, you know, the return profiles are really, really strong. The other trend that we're seeing are these angels or quote solo capitalists. This seems to be a really, really important trend that's happening. And they're basically serial angel investors that are starting small funds. And their ability to access startups at their very, very earliest stage. And it seems like a lot of founders are seeking these solo capitalists out or these serial angel investors out because they think they can move fast, they have strong networks, they can get them networked very quickly, they have strong relationships with other VC firms that are, you know, kind of at the different stages, you know, Series A, B, and C, so they can help with that. They can even help with company formation and company building and growth as well. So, you know, we see that as a really, really interesting trend that's happening.
Okay, thank you. Bill. Okay.
Yes. So the trends, I guess, that we've seen per COVID are in the healthcare space, where we do a lot of investment. Initially, we saw everyone was pivoting toward the vaccine cure. And obviously, not everyone was going to get to the vaccine cure when the big guys out there, AstraZeneca, Pfizer, Moderna, et cetera, were working on those vaccines. So the chances of them pivoting from a particular point of what they were doing to COVID vaccines, we knew was not going to work, because there can only be one, maybe two winners. So there's not going to be 100 winners all at the same time. And obviously the big pharma has an advantage. So we wanted to make sure they stayed with their platform investments. And the healthcare space has done very well. We've made several investments in the healthcare space, from life science, digital health, and medical device. So three major areas where it performed very well because of the interest in healthcare, and healthcare investments have very good returns for us. The other space we've done a lot of work in right now is the digital transformation space. And that digital space is very important. We have one company right now which is going to transform the knowledge space. So instead of going out and searching for knowledge through AI and machine learning, it will come to a particular research analyst, CIO, CEO, needs that internal information via the enterprise level, and external information, including paid, like from Bloomberg, to make the right decisions along the way. So we have one company that is doing that. But you know, in that space, one of the major companies in this space, they're BCG, Forrester, et cetera, has spent over $30 million in just how are they going to differentiate within this digital space. Another one will go to the enterprise level and bring different sectors to that enterprise so they can see that via, again, a digital transformation of these industries. And lastly, we have one in the fashion industry, which is, it's a B2B, not a B2C. And in that particular area, what they're doing, they're taking the manufacturing, the distribution, the branding, and the try-on side, all that above, and transforming it into digital applications. So we see a lot of that happening. There's also, just a one note, there's another company which we're looking at out there. It's called Spatial. And this is it's going to be a Zoom, plus an added feature to Zoom, which, what does that mean? It means 3D, three-dimensional. So as we're sitting here in a panel, we'll be able to see each other on a holographic basis and be able to see these people in different points right within our room. So they need a headset to do that today, but eventually we can do it without headsets. Kind of interesting technology development.
Nice. Neil, any new investments?
Yeah, we actually made our first allocation to a fund where we've never met them. So that was new for me. You know, it was a manager who wasn't based in New York, and, you know, in normal times I would have hopped on a plane and we would have gone over there and had multiple meetings, but, you know, we're continuing to do business. So, you know, maybe the new piece is we're doing additional reference checks. So maybe, you know, that's one way you're coping, and, you know, having, you know, more meetings via Zoom than maybe you would in person. But I think, you know, one change for us is maybe getting more efficient with our meeting times, and you know, potentially getting more people involved. You know, in the past I may have flown myself, but now we can get our CIO and other folks involved and have more meaningful contacts more regularly. So that's been new.
Gotcha. Ahmed, how about yourself?
Yeah, so we just announced Site Diagnostics of the $71 million round. We've also led a couple of other rounds in companies that they just closed. We haven't announced them yet.
Okay. Great. My last general question. So, I mean, with a vaccine on the horizon, if you believe it is, do you see major shifts in the economic environment, working environment, and investment environment in the tech world? We can start with Bill.
Yeah, that's a very timely question here in terms of what's going to happen on the economic side. The stock market, evidently, if you look in the historically what's happened here, it's unprecedented. The bounce back from the March, April lows. You know, it looks not just one year ahead, it's probably looking 4 or 5 years ahead, because the disruption in the economic side in terms of GDP has been tremendous. Certain of those industries will not come back. Small businesses, by the way, which we're talking about here, it's been a disaster for small businesses, and that will obviously, that trend was pre-COVID and will continue. It's accelerated by COVID too. So you see fewer small businesses that are going to able to survive in this post-economy. Airlines, transportation, hotelers, Airbnbs. What's going to happen? People eventually go back when there's a vaccine answer here. But is there going to be, you do a lot of reading, is the vaccine going to be the answer? Example, what percentage of people will not take the vaccine, and they think it's going to be very high, either because they're afraid of it or they don't believe in it or whatever the answer is. So that means the herd immunity is going to take longer to achieve than we think. And the vaccine, I know Russia has just announced that they have one. They didn't go through phase 3, they went through phase 2 clinicals. So we have to go through phase 3. So will it be effective? How long will that vaccine be effective for? The antibody side, it's not going to be effective for that long. It's anywhere from 1 week to 6 months, depending on the viral load of COVID that you had. In terms of the bounce back, in terms of timing, I think it's going to be the end of next year, 2021. If you look at what Google's done, for example, look at what they've done. Their employees they're all working virtually, but they're not coming back until 2021 of July. What does that do to the economy in California? You know, they spend a lot, they travel a lot, et cetera. If no one's doing that, this continues to go, it means that it's not going to be a vibrant rebound. Lastly, I think the statistics show, in terms of the Fed and projections on out, this could be a 3 to 5 years before the economy comes back to where it was pre-COVID.
Right. Neil, do you have any comment on this?
Yeah, I agree. The market is pricing in 5 years out. I think that was said very well. You know, one thing we've heard, you know, from our managers is that, you know, especially in you know the hardest hit sectors, you know, your real estate, your nursing homes, your travel, hospitality, a lot of folks are you know, kind of bargain shopping in those areas, particularly with some of these REITs out there. But I think one fundamental shift is that, you know, there will be a long-term depressed for commercial real estate, for, you know, these types of real estate linked investment strategies, which there are lots of, and you know, they exist across lots of different portfolios and 401ks, and, you know, lots of Americans have exposure to real estate that they may not necessarily be mindful of.
Yeah, Ahmed, please.
So, I mean, we've done a ton of work on it and gathered significant amount of point of views on this, and we're fortunate that we're private, so we're not subject to these market movements. And it comes back to our core belief, right? So we don't worry about short-term shifts and what's going to happen in the short term and what the market view is thinking. For us, it's all about, our thesis is if it's a highly disruptive business with massive potential and we're long-term investors, it really shouldn't matter in the short term. Do we think there's tailwinds or headwinds caused by COVID to these businesses? Yes, but if we're, being compensated adequately for those, that's how we think about the lens we use.
Gotcha. Steve, please.
So we try to stay away from predicting in the macro as much as we can. But I'll just mention a couple of things that I think is interesting. I think the whole tailwind to healthcare and biotech in general, and it's a lot of it is around, recently around COVID. And I think you really need to be careful on the vaccine side, because vaccines have traditionally not been very profitable for pharma. It's an area that pharma has traditionally stayed away from for that reason, just like they have traditionally stayed away from antibiotics. So, I think this euphoria on the vaccine and the amount of money you can make on a vaccine, et cetera, there needs to be some caution there. Where I think there could be some interesting opportunities is in the ed tech space. Ed tech has traditionally not been a good space for venture, but there is a tremendous amount of disruption that's happening right now in education. And certainly with what's happening on the municipality side with tax revenues and everything else that's going on and the potential for disruption for other potential pandemics, et cetera, I think ed tech is a really, really interesting space.
Gotcha, thank you. Steve, we could just stay with you for the last general question. It's going to be short. Has your portfolio management changed in recent times?
It hasn't. I think our biggest challenge, especially when these tail events they've been happening more and more frequently of late, is trying to keep our behavioral biases in check. Because you just start thinking that, hey, you need to do X, you need to change your portfolio Y, you need to take advantage of this trend or what's going to happen down the road. And you're just being hit with all kinds of, things that is even more than it has been because of this strange tail event that's happened. And really, I think what we focused on is making sure that we stay invested and that our core theses are playing out in our portfolio construction. And we're taking advantage of what's happening with the disruption and the recessionary time periods to stay invested and stay focused on compounding capital.
Gotcha. Bill, do you have something on this?
Yeah, we look for, basically the overall management is we look for IRRs in the 15 to 20 IRR category, and that's over a 4 to 5 year period. That's the thesis of how we invest. To solidify that a little bit, what we look for is partnerships, strategic partnerships where they're involved. We look to where the exit's going to be before we make the investment, because that cuts down on the write-offs. Again, the write-offs are very important in terms of getting our returns up. So that's one thing we look for. We diversify across the spectrum. So what that means is real estate, private equity, M&A, real assets, venture, well, those 4 categories of alternatives, we want to balance those. You can overweight in some of those categories, but an overall balance in that will give us really good returns. That's, and obviously in addition, whatever the stock portfolio is. Bonds we avoid at all costs. We actually think there's better play in real estate in terms of returns than there are in bonds today, especially if you can get some royalty type structures in the real estate side, returns to investors coming in much better than the bond side.
Right. Neil, portfolio management.
Yeah, I think for us, same things. We haven't made any real structural changes. We continue to do what we've historically been doing, looking for alpha and being diverse, both in terms of sectors and geographies. Okay.
Ahmed, any comments on this?
I mean, we tend to be we're growth equity investors and venture capitalists on the VC side, early side. I mean, we tend to just be, we're just by nature very involved, right? Because we believe we have all these capabilities to bring. to different companies through Koch Industries. So we've been spending just as much time with them as we typically have. And for us, our, if our underwritten thesis hasn't changed, we're very.
Gotcha. So that does it for the general questions. I have a couple of specific questions for each panelist. Neil, we could start with you. How does your experience in hedge funds and as a government forensic investigator, white-collar crime, help you as an investor?
Yeah, so I started my career like a lot of people. I went into investment banking, and then after that, I pivoted. I was a financial crimes investigator for the government, and did that for a while. And then I got a call from this hedge fund in Manhattan, and they were looking for somebody who had banking experience and forensic accounting experience. So I kind of winded up in this hedge fund office, and it's interesting because my background really is looking for financial crime, so to the extent somebody is fraud or using, clever accounting tricks. So my role at the group is I'm head of due diligence. So, making sure that we're not getting involved in any sort of fraud type situations. And I think our investors appreciate that.
Yeah. And what's the relationship between Forbes Family Trust and Optima Asset Management, Neil?
Sure. So Optima is a very kind of old school New York based hedge fund group. It was started by Dixon Boardman in the 80s. So the peak assets for Optima were roughly $7 billion pre-crisis. About a year ago, Optima was acquired by Forbes Family Trust, which as you know is a multifamily office. So it was one of these rare good fits because Forbes is a fixed capital looking for new opportunities, and I came from the Optima side, so we were kind of specialist hedge fund investors. So it was a very good natural fit. So now the combined assets are in the $6 billion range, and we do invest across all strategies and geos.
Thank you. Ahmed, you may have answered this question already, but anything more to add to how does the investment strategy at KDT tie into the operating businesses of Koch Industries?
Yeah, so what we look for is one of our criteria is what can Koch bring to the companies and what can the companies bring to Koch, right? So, one of KDT's, foundations is transformational value to Koch, but that doesn't mean we don't call ourselves a CVC. We don't think like a CVC. So we're financially driven, but what value can we bring to a company? And sometimes it's like really high, like, hey, we can be a lab for you to rapidly develop your product. Other times it's things like more simple, like, oh, you can benefit from our economies of scale. We can introduce you to customers. We can introduce you to suppliers. We have a big legal capability. We have a big accounting capability. We have capabilities we own, I think, the third largest trucking company. So here's all the menu of things we can bring to you. Now it's up to you on which ones you want to work with.
Gotcha. Now I know you've lived in California and New York, and you recently moved to Wichita, Kansas. So how is that qualitatively different from the coast in terms of deal sourcing, networking, and general quality of life?
In a COVID perspective, deal sourcing is no different. From a pre-COVID perspective, it just means an extra flight to get somewhere. On a quality of life thing, it's just very different. I went from a small apartment in New York to a house with a pool, so it's just
yeah, it sounds good.
From that perspective, it's been you get a lot more for your money out here in Wichita, Kansas than I got in New York City or San Francisco.
Yeah. Thanks. Steve, how does Virtus look at investing in fund managers versus direct investing in tech companies?
So we traditionally only invest through funds. We've done some direct investments, but they're typically on the real estate side. And the reason for that is, we like the diversification. We think it's really, really paramount in early stage investing that you get that. We think a lot about, that early stage venture looks like a power law. When a distribution looks like a power law, you need to be in the outliers. And in order to get a high probability of being in outliers, you need to do a lot of deals. So it's really difficult for us to do that kind of volume directly. So we use funds. And that's worked out really well for us. It levers things up for us as far as ability to get the volume that we need.
Gotcha. And with your tech and CTO background, do you tend to approach deals from a tech perspective before weighing the business fundamentals, or is it because you're investing in funds that doesn't come to the picture?
So that's a great question. So, I try not to let my tech background actually, make a call on a particular company or a particular fund. Though, kind of the way I see it is I would have never picked out Twitter, 10 years before it became Twitter. So I think probably, a lot of times that, if I like a product or I use a product, I'm probably biased, and I try not to be that way. And I think, and that's the reason that we've become very, very data driven in kind of what we look at. We use data science really heavily to make our investment decisions. And that's helped me stay grounded and not letting my tech preferences make investment decisions.
Thank you, Steve. Bill, how does your experience in larger financing deals relate to your investments in tech startups, which are relatively smaller?
Actually, it's kind of interesting from that background. The larger deals, obviously, is a matter of doing a lot of due diligence, especially on the legal side. From the banking side, it was putting these large conglomerates together. So a lot of different pieces. We had a lot of experts that were involved in each of those different pieces. And what we're doing at Landmark, we have a 3-person review committee that basically responsible for the deal flow and also making the ultimate decisions, but the individual investors are making those decisions. So we have to look much earlier. When we look at my corporate experience comes in handy because we have a lot of potential places to go to look at the underlying technology to see what they think. In other words, what is the company X who's likely to be a customer or even a potential acquirer? What do they think of that particular product? How are they using that technology? We can get feedback there. So if they're going to be a customer, that's great. If they don't have any interest in it whatsoever, well, it gives us a pause as an example. But we look at everything. I like the early stage space where we are, early to growth stage, I should say, where we are, because it gives a lot of verticals to look at. We stay attuned to all the different things that are going on in the world, the economy, and these particular companies. And we can help these companies too, in terms of, because we have the experience. Certainly when it comes to term sheets and et cetera, I've got the corporate experience that can help these companies and plan in advance. And that goes through detailed business plans and also their term sheets.
Gotcha. And how do you sync your 3 entities to work with each other, and where do you spend the bulk of your time?
Landmark Capital is our consulting banking group. We've invested in a lot of deals over the years, and so we choose generally about 4 to 5 companies a year to work with on a hands-on type basis, meaning we do everything for them in terms of putting the whole deal structure together. And the angel side of what we do is we do it through our forums. We have about 12 forums a year on average. We have a specific family office forum just for our family office investors to go over things that they're concerned about, both from the soft side internally to the investment side. And the Landmark Family Office is, I spend a lot of time on the family office side because those are our key investors. And we want to make sure the key investors that we know what types of deals they're looking for, what stage, how much capital they want to put in, developing co-investment opportunities among our family offices to form syndicates. So I spend a lot of time in that side of it as well.
Thank you, Bill. And really thank you to all our esteemed panelists for sharing their wealth of knowledge. This has been a great session, really.